My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make a little money. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Not one, not two, but 3 numbers went the way of the bulls today. And it was a welcome relief from the seemingly endless sell-off. Sell. That's how the Dow could surge 701 points, while the S&P shot up 2.28%, and the Nasdaq pulled 2.56%.
House of pleasure.
Coming in this morning, we expected that the economy would run too hot, employment would escalate, wage inflation would be spiraling out of control. Yeah, we would get some booming factory orders. ISM services data showed the cost of services remained too high. It was all just... Instead, we got something very different. Despite the headlines about a strong labor report, we got a set of numbers that show what may be an inflection, a bullish inflection. With wage inflation coming in lower than expected, factory orders were downright weak. Most important, and what really spurred today's rally, ISM services were astoundingly soft, something I didn't know a soul would expect. Put them all together, and this was a huge win for Jay Powell, our much-maligned Fed chief. And by the way, he is much maligned. But now it looks like he may be landing the economic plane without the need to even foam the darn runway. These numbers were so unexpectedly weak that Treasury yields had a big gulp down, to the point where I even felt the dividend stocks might not have such tough competition from the bond market. However, as good as these macro numbers were for the market, they'll become a sideshow when we actually start getting earnings reports, and that happens at the end of next week. But you know what? Let's not get ahead of ourselves with the game plan. On Monday morning, the J.P. Morgan Healthcare Conference gets rolling, and I think we're going to hear multiple good stories from these companies, especially Johnson & Johnson on Monday and Eli Lilly Tuesday, both of which we own for the Travel Trust. We'll be talking about them in our home stretch 2:30 p.m. program if you want to know what they've been saying. Now, you know these are 2 of my favorite companies with amazing prospects this year, and I think you should own them. We also hear from one of my favorite smaller financials. It's a company called Jefferies. I don't talk about it much. It's a boutique investment bank firm. I think it'll be an ideal tell, though, for the large banks that are reporting at the end of the week. The banks got hit with a number of downgrades today, yet Jefferies is near a 52-week high. If they say all systems go, that means you might want to buy the big financials ahead of their earnings. Now, Tuesday brings us Albertsons. And this is a case of both inflation, how much of prices really going up at the supermarket, and what's the word on their attempted merger with Kroger. Over the weekend, I read an essay called Market Power and Inequality. It's co-written by Lena Khan. She's the head of the Federal Trade Commission, and it was in the Harvard Law Review. This is one of the most anti-merger things I have ever read all my life. I spent a lot of time studying this stuff at Harvard Law. The most emphatic moment in this paper is when Khan talks about, and I quote, spectacular failures of antitrust, with the poster boy being the previous merger of Albertsons and Safeway, a predecessor to the current Kroger deal. Back then, Albertsons sold a bunch of overlapping locations to a much smaller competitor, Hagen, which quickly went bankrupt. Then they bought back dozens of those stores. I think Khan's way too much of a hardliner, but in the particular case, she's right to be angry. Now, I know someone at Kroger must have read this article before they decided to go ahead with this deal, but to me, it's clearly dead on arrival. Sure, they can fight the FTC in court, and they probably should win. Although, at this point, you're probably gambling on which kind of judge they get. Next, the Fed cares about wage inflation, and the less than spectacular numbers we got today made people feel safe buying the metals and the chemicals and the home builders. But are we really safe? On Wednesday, we get results from KB Home. you better pay close attention because the Fed wants lower housing prices. KB is the first to report after the most recent rate hikes. So we need to know if these sales are finally being impacted by higher mortgage rates. And more important, are housing prices finally coming down? Remember, today's macro numbers are a prelude to declines, or at least that's how Wall Street sees it. KB will tell us if it's actually happening. Thursday, we get the Consumer Price Index, and that's still one more important piece of the Fed puzzle. Not as important as the numbers today, but still a hot button. If the CPI is cooler than expected, we'll get another good day, although not as much as today, because that weaker ISM services number was the thing that really spurred the rally. Now, we won't have to wait long to find out how important the CPI might be, because St. Louis Federal President Fed President James Bullard speaks later today. Now, Bullard, he's been on the hawkish side, but he gave a presentation yesterday, what a prescient one I must add, that indicated concerns about the slowdown in the economy could be genuine. And he doesn't want to be too dogmatic about the rate hikes. We could get a weak number, and it could be impactful. Then again, as of this week, Bullard's no longer a voting member of the Federal Open Market Committee, which is what calls the shots. So he might not have as much sway with the market as he did last year, but he does with the media. Friday, let the games begin. Wall Street's turned cautious, if not downright negative, about the bank stocks. Yeah, thanks for nothing now. Yeah, but Wall Street's worried about possible loan losses and the need to build reserves to get ahead of that weakness, rather than focusing on any of the positives that come from higher interest rates. Remember, every rate hike instantly makes the banks more profitable. I think it's nuts that this group has fallen way behind the market. To me, it represents great value. On Friday, we hear from Wells Fargo, now down 20 points from where it was trading 5 years ago. Meanwhile, the Dow Jones Industrial Average was at 25,000, and now it's at 34,000. Wells has the most room to run, and I think it'll do just that, which is why it's one of our biggest positions for the Charitable Trust. I expect J.P. Morgan to put up fine numbers, although this one's just won from 101 October to nearly 138 now. Ooh, that's big, including another 2 points today. Bank of America should deliver consistently great numbers. That's what they seem to always do lately. And then there's BlackRock. Well, I expect them to talk about some sluggishness in their assets under management because of the bear market. I'm betting that proprietary technology will once again allow them to beat the numbers. Finally, maybe we can get to the bottom of the decline in United Health Group, one of my favorite stocks. Some say it's because of potential shortfall in employment, because as a health insurer, they are levered to the size of the workforce. But when we spoke to J.P. Morgan's Lisa Gill yesterday, she questioned if it might be a combination of news out of Washington, including the possibility that Democrats end up nominating someone who tacks further left than Joe Biden next year. Lately, there hasn't been much talk about price gouging by the healthcare industry, but that could easily change depending on who ends up running for president. Bottom line, the streets prep for huge disappointments once the results start rolling in next week. That's maybe the most positive thing I can say about earnings season. But I'll take low expectations over high expectations any day of the week. William in Michigan. William.
Hey, thanks for taking my call, Jimmy.
My pleasure, hey. William. Jimmy Chill at your service. What's up?
Hey, one pays a dividend in the second month of the quarter, and one pays a dividend in the third month of the quarter. Is it okay to own both, EPD and PXD?
Well, I care more about diversification than I care about anything else. And one is a pipeline company. They're both excellent companies. But they're not why you necessarily buy these stocks. You buy it because you think oil's going higher. I like Pioneer best. I think that's the one you want to be in. All right, the streets prep for huge disappointments once the results start rolling in next week. You know what? Maybe that's the best thing I can say about ahead of earnings season. When everybody's negative ahead, that's not so bad, right? I'll take low expectations over high expectations any day of the week. Oh, man, money today. Yesterday was a tough day for the market, but an even tougher day for an outfit called Silvergate Capital. So why does the crypto outfits fall from grace? What does it mean? What does it mean to the entire crypto ecosystem? What does it mean to you? I'll give you my take. Then 2022's biggest losers in the NASDAQ were much easier to find than the winners. I'm taking a look at the bottom 25 stocks, see if anything can pose an enticing buying opportunity for the next year. And drone manufacturer AeroVironment will shed some light on how the war in Ukraine is impacting defense contractors and its bottom line. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.